Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, ice raw sugar in New York. The main pattern here since September 2024, so it's over a full year now, had been and still is, though it was once again breached and repaired only a few weeks ago. It is the dark blue September to December 2024 bear channel, currently 1173 to 1613, that has developed into a descending expanding wedge pattern. We are today under all the moving averages, as well as the dark blue upper trend line of this pattern. There are two other patterns that have greatly influenced this market. The first, the oranges of which I've spoken about at length, and it is the bright green late September 24 to mid-January 25 bearish shift pitchfork. Now, I drew the original bearish Andrews pitchfork for this move some 31 weeks ago, and it seemed back then to be a better contender in showing the bearish angle of attack. But this is no longer true. And I finessed it to the shallower bearish shift pitchfork for the same move, which is much better at showing the bearish angle of attack. Today we are in between the overhead bright green middle time, which is approximately 1574, and the bright green lower time below, currently at 1349. The second is another bit larger bearish pattern, which I had also previously spoken about, and a good contender even now in showing the bearish angle of attack. It is the longer term bright red November 23 to September 24, similar but slightly shallower bearish shift pitchfork. On this one we closed on Friday right on the bright red middle time, which is currently at 1497. And today we have punched down below it with some vehemence. This ties in with what I said last week and in recent earlier weeks, and I quote, "I suspect something's going to give and soon. I'm on the watch out for what it will be," end of quote. The move higher 3 weeks ago could have been it, but as I said at the time, and I quote, please be aware that this might still be a false break, end of quote. And it was. Today we have a break lower, down through the previous significant low in late June at 1468, down to a new low, one that has not been seen since December 2020. We next have support on the downside in a congestion based around the significant 61.8% absolute Fibonacci line for the 21st century at 1383, which stretches from 1409 down to 1379. All that is needed for these to be tested is stabilization under the bright red middle time, which is looking likely at the moment. Ice Europe white sugar in London. After all this time, there still continues to be three features of this market to keep bearing in mind on this daily chart. The first of the three patterns is the obvious and broken, then repaired and then broken again. Purple late September 24 to mid-February 25 descending expanding wedge pattern. Currently 445.5 to way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary, made back in January this year, and earlier been severely tested on the top side, especially between late February to mid-April. Enough that would not necessarily classify it as a descending wedge pattern after February, though I continue to still keep an eye on the extension to the upper trend line and the recent seeming failed break above it, as well as the changeover gap 6 weeks ago, as I believe it all to be significant. Next, I also asked you 26 weeks ago too, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25, recently finessed bearish shift pitchfork. This is a very shallow pitchfork. The more the market moves lower through it, the more I'm beginning to like it, end of quote. Well, since then, the market started utilising the bright pink middle time of this bearish shift pitchfork, which is currently at 462.10, as an attractor. Riding prices lower in a shallow glide until early October, when it started a further, steeper journey lower, such that the pink lower time, which is currently at 403.80, now comes into focus and possibly into play as a potential support. The first time in the life cycle of this pitchfork. The third feature now comes into play along with a new feature. Thus we have a fourth, though I suspect we may be back down to 3 features by the end of today. The third feature is the rectangle pattern formed between June to September, which, when we had the break lower in early October, gave a primary target of 436.20, reached 2 weeks ago, and a secondary harder to reach target X for the same move down at 418.80. Today the market has achieved the harder to reach secondary target. Now the fourth new feature has developed over the last few weeks since the beginning of September and is the red bear channel, currently at 411.90 to 443.40. This continues to show some promise, though I do note how few the touches on the downside have been, something that goes against this pattern somewhat. However, with today's action making the lowest low since July 2021, it is worthy of closer attention. This is also another reason as the red lower bear channel line crosses the pink lower tine next week, and I would look out for some potential volatility around the middle of next week perhaps. Sugar white premium spread. I said 6 weeks ago here, and I quote, "Things seem to be trying to resolve themselves into a pattern," end of quote. And over the intervening weeks they seem to be doing so, just not always the way that I imagined they would. You see, I thought we might be moving towards, as I cautioned for a number of weeks, and I quote, "I have a fear, and it is a real fear, that the whole February to 2025 today action may be trying to form a possible diamond pattern." End of quote. Now I continued, and I quote here also, "This would be a large pattern in time, probably from February to November this year, and in height roughly between just under 100 up to 150. Too early to say if this is happening, but I would urge you to keep an eye on such a possibility." End of quote. Now that possibility looked like being a real possibility until 6 weeks ago, when the market dropped down below what I thought would be the lower bullish trend line for this pattern, which is highlighted in dark blue and currently at 120 3/4. The market not only dropped below this trend line, let's be honest, unjustified trend line, but went on to drop and close below the gold long moving average, currently 104.5, and stabilized further down, dropping and closing below a new support line, which is the bright red neckline, currently at 97.5, of a new simpler pattern that the market opted to utilize instead of a more complex diamond pattern, and that's a February to early October head and shoulders top, or it looks like that at the moment. We were, and I suppose might still be, at the early stages of this pattern, but I thought it was appropriate 3 weeks ago to lay out some potentials below for such a pattern just in case. Thus the primary target X is in the 70 even zone, with a secondary harder to reach target X1 down at 43 3/4. You'll easily note that the primary target X is at the lower end of the congestion seen between September 2024 to January 25, between approximately 70 even to 85 even. Since then, prices may have stabilized, but have not followed through lower, and indeed we opened and closed last week and opened this week above the bright red neckline, if still below the gold long moving average. It was, as I said 3 weeks ago, and I quote, "Only concerted, consistent and longer term moves over the new bright red neckline, and ideally over the slowly rising long moving average, could possibly assuage the bearish potential, at least as far down as the 70 to 85 even congestion." End of quote. Now we are half there and half not there, and this still seems to be the case this week.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.